Good morning. We will pay attention to the periodic inventory system today. We will pay attention to the various transactions that will be affected when you use the periodic inventory system. The first entry is when we buy goods for cash. When we purchase goods in the perpetual inventory system, we debit the inventory account. When you use the periodic inventory system, you are not allowed to record any entries in your inventory account during the year. Therefore, we will open a purchases account when goods are bought with the purpose of selling in the future. So the purchases account is debited. Because we pay cash, the bank account is credited. The very big difference between purchases and inventory is that purchases is an expense, while inventory is an asset. So remember that this purchases will have an effect on your expenses, therefore your equity will decrease. The second transaction is when you purchase goods on credit. Again, you are not allowed to write in the inventory account, so you debit your purchases account, increase expenses, and you credit creditors control to increase your liabilities. When goods are sold for cash, in the perpetual inventory system, we will do two double entries. One for the sales price and another double entry for the cost of sales. In the periodic system, you never use a cost of sales account during the year. You don't calculate cost of sales every time when goods are sold. So there will only be one double entry for the sales. So because we are selling it for cash, the bank account is debited and the sales income will increase on the credit side. When goods are sold on credit, we sell to debtors, so the debtors control account is debited and sales income will increase on the credit side. In both cases where we sell goods, either for cash or credit, we will not record anything in the inventory account or cost of sales account when the periodic inventory system is used. When goods are returned to creditors, the creditors control account will be debited to decrease the amount that the creditors owe the business. And now we have an additional account in the periodic system that we don't have in the perpetual system. Because we don't use our inventory account, we have to show that the purchases must decrease, and we will decrease the purchases opening a creditors allowances account. So that means creditors allowances will decrease the expense for purchases, and therefore it will increase my equity. Goods returned by debtors. So when we sell goods for cash or on credit, or the debtors return it, in the perpetual inventory system, we will record two double entries, one at sales price and one at cost price. In the periodic inventory system, we don't record anything in cost of sales or inventory. So therefore, I will show that the debtors control account must be credited to decrease the amount owed by debtors, and debtors allowances is debited because we want to show that the sales will decrease as a result of the goods that was returned by the debtors. If inventory is donated, the donation account expense will increase on the debit side. In the perpetual inventory system, we will credit inventory because we reduce our inventory. In the periodic system, we are not allowed to write in the inventory account. So I want to show that the expense for purchases decreases, and therefore I will credit my purchases account. So when I buy goods, I debit the purchases account. When we give some of the goods as a donation, it means that we credit purchases to reduce the expense. Carriage on purchases or import duties that you pay when you buy goods will be recorded in the carriage on purchases account or the import duties account. So we create two expense accounts for the expenses that we pay when we buy goods. and we will credit the bank account to show that the money is taken out of the bank. When the owner takes goods for its own use, you will debit drawings, and again, you will debit purchases when we buy goods. When the owner takes it for its own use, it means that we will credit purchases to reduce the expense for purchases. If you take stationery out of the business, for instance, to use in the office, or you take inventory to use for a marketing or a promotion, it means that you will create an expense, debit the expense, and show that the expense for purchases will decrease. What did we learn today? When the periodic inventory system is used, you will open a separate ledger account for every expense that you pay when the goods are purchased. So you will have a purchases account, carriage on purchases account, import duties account. All expenses occurred when we buy the goods to get the goods to in the condition that we want to sell it, or to the location where we want to sell it, will form part of the cost price of the goods. So all these expenses will be recorded in the inventory account when we use the perpetual inventory system. When we use the periodic inventory system, we will open a separate account for purchases, carriage on purchases, import duties. So we create expense accounts for all the expenses that we pay. The value of inventory on hand at the end of the year or at any time during the year can only be determined by doing a physical inventory count. So in the perpetual system, you can balance your inventory account to determine how much inventory there should be in the business. In the periodic system, there's no way to calculate how much inventory is available except if you do an inventory count. Inventory shortages can only be traced if you know what is the gross profit percentage, and you use your gross profit percentage on the total sales price to determine what the closing inventory should be, and then you see, okay, it's less than that amount, so we discover the inventory shortages. No entry will be recorded for inventory shortages when we use the periodic inventory system, because this will be absorbed in the cost of sales figure, because if the closing inventory is lower, the cost of sales figure will automatically be higher.